Welcome to the One Deal Millionaire Podcast, where we don't just bounce properties, we flip mindsets. I'm JD Allen, Marine Corps veteran, engineering leader, and your multifamily investment mentor. If you're stuck chasing small gains, we're here to change the game. Each week, we dive into strategies to bounce your way to your first million. No fluff, no hype, just real talk, real deals, and real momentum. Smart money. The disciplined investors, the ones who've studied the lessons of 2008, are not scrambling. They're waiting. They've been pursuing with patience. They've been building cash reserves, watching from the sidelines, knowing that every crisis will create an opportunity. They're not the ones making the capital calls. They're the ones preparing to answer them. You ever got the feeling you've seen this movie before? Back in 2008, we watched the real estate market implode. Family lost homes, investors lost fortunes, banks went under. And right now, 2025, I just can't shake it. It feels eerily similar, kind of like deja vu. The names have changed, the causes look different on the surface, but the story, it's starting to sound the same. Today, I want to take you through a story using 6 beats: life before, the crisis, pursuit, conflict, climax, and an aftermath. You're going to hear about how the patterns of 2008 echo through what's happening in foreclosures today. And you'll also see why, if you're paying attention, this isn't a time to panic, it's a time to prepare. So let's rewind the clock. Life before the crash always feels good. In fact, it feels so good that most people can't imagine anything going wrong. Think about the years leading up to 2008. Money was flowing. Banks were writing mortgages like candy at a parade. If you had a pulse, you could get a loan. They called those non-conforming loans, the kinds that didn't fit in traditional boxes of Fannie Mae or Freddie Mac. Ninja loans, no income, no job, no assets, interest-only loans, balloon notes, adjustable rates that started low but reset higher. And on the surface, it looked like opportunity for everyone. Families who never thought they could own a home were moving into a brand new subdivision. Investors were flipping properties and doubling their money overnight. Builders couldn't pour foundations fast enough. The American dream was alive, at least on paper. But under the surface, the loans were a trap. They worked as long as housing prices kept climbing. The second they slowed down, everything built on those non-conforming loans started to wobble. Now fast forward to today. The faces have changed. The products have different names, but the story feels very similar. Instead of subprime mortgages, we got bridge loans and short-term commercial debt. Syndicators raised billions of dollars from investors between 2020 and 2022. Hungry to place that money, they overpaid for multifamily at record low caps, 3%, sometimes even less. They promised investors big-time returns, betting that rents would skyrocket forever. And here's the kicker. They structured those deals with interest-only, floating rate loans. It looked great on paper, just like non-conforming mortgages did back in 2008. But the problem is simple. The numbers never penciled in the real world. They were all pro forma and they were made up. Insurance costs doubled. In some states like Florida and Texas, they tripled. Property taxes climbed, and now those short-term loans are coming due, just as interest rates set at 20-year highs. So what does this remind you of? Back then, life before the crash was full of optimism. New homes, cheap credit. Today, it's glossy marketing decks from syndicators, aggressive underwriting, and properties trading at nosebleed prices. And just like 2008, everybody's telling themselves the same lie. It's different this time. But history doesn't work that way. Life before always feels like a party will never end, until suddenly it does. But every story has a turning point. Back in 2008, the turning point came when those non-conforming loans began to reset. Families who thought they had scored the American dream suddenly faced mortgage payments they couldn't afford. That $1,200 monthly note they had budgeted turned into $2,000 overnight. Adjustable rate mortgages spiked, balloon notes came due, and the refinancing lifeline they had counted on disappeared. And just like that, poof, the dream became a nightmare. Foreclosure signs multiplied, entire neighborhoods emptied. Banks realized the paper they were holding was toxic. That was the crisis then. Let's get to today. The cracks we're seeing in 2025 are just as real. They look different on the surface, but underneath it's the same old story of over-leveraged debt, rising costs, and deals that never actually made sense. Here's what's happening. Interest rates that were 3% in 2021, now 7%. Every one of those floating rate short-term bridge loans, they've doubled in cost. Insurance premiums have exploded in Florida, Texas, Louisiana. Market syndicators flooded into. Insurance has doubled, sometimes triple. A property once budgeted $120,000 is now paying $350,000. Property taxes are climbing as cities reassess values, desperate to cover their budgets. And the biggest piece, syndicators overpaid. They promised their investors big returns, and in the frenzy, they bought at cap rates so low, the deals only worked on paper. So what does all of this mean? It means cash flow is gone. Properties that were supposed to be producing distributions are now bleeding money every single month. Syndicators are hitting their investors with capital calls. Some investors are refusing to send more, and banks are watching closely. And here's the quiet truth nobody wants to say out loud. Many of these properties aren't even worth what they were bought for. Some aren't worth what they owed on the loan. That's the crisis. It's not just one property here and there. It's a systematic pressure building across the country. And just like in 2008, the numbers don't work anymore. And once the numbers don't work, it's only a matter of time before the foreclosures start. The party's over, and the market is about to find out who was swimming naked when the tide went out. Now, whenever crisis shows up, people scramble to fix it. That's human nature. Back in 2008, when homeowners started defaulting, the pursuit began. Families begged banks to modify their mortgages. They tried to refinance, but the new rules meant they no longer qualified. Some stopped paying altogether, hoping for government relief. Others simply walked away, leaving behind homes they thought would be theirs forever. And investors did the same thing. They rushed to sell before the prices fell further. They tried to hang on, patch holes, or push tenants harder for rent. Everybody was looking for a way out. Now let's fast forward to today, and you can see the same frantic pursuit playing out in multifamily and commercial real estate. Owners are racing to restructure their loan. Syndicators are going back to lenders, asking for extensions, praying for another year to turn things around. Some are raising capital calls, asking their investors for more cash to cover ballooning expenses. Others are quietly listing properties, hoping someone will buy before the debt comes due. And then there are the banks. They're pursuing their own path, trying to figure out how to minimize damage. Do they extend and pretend, pushing the problem down the road, or do they pull the trigger and take the property back? But here's the other side of the pursuit, smart money. The disciplined investors, the ones who've studied the lessons of 2008, are not scrambling. They're waiting. They've been pursuing with patience. They've been building cash reserves, watching from the sidelines, knowing that every crisis will create an opportunity. They're not the ones making the capital calls. They're the ones preparing to answer them. By stepping in when a property goes back to the bank or when a syndicator finally admits that they're underwater. The pursuit in 2025 is going to be twofold. Some are desperately trying to survive. Others are calmly preparing to thrive. And that's always the divide. In 2008, most people were in survival mode. A few were in opportunity mode. And the few who pursued opportunity in the middle of the chaos built generational wealth. The same thing is definitely happening right now. The question is, which pursuit are you going to choose? Are you going to chase survival or pursue opportunity? But pursuit never comes without conflict. In 2008, the conflict was brutal. Homeowners thought banks would work with them. Some begged for loan modifications. Some mailed in paperwork for programs that never came through. But the truth, most lenders slammed the door shut. Banks were overwhelmed, underprepared, and unwilling, and families lost homes in record numbers. Investors faced the same wall. They tried to sell, and the buyers disappeared. They tried to finance, but new lending rules blocked them, and every path forward ended with a dead end. That was the conflict now. That was the conflict then. Now look at the conflict we're facing today. Syndicators promised their investors double-digit returns, but those distributions have stopped. Investors are calling, angry, demanding answers. Some syndicators are asking for capital calls, essentially begging their investors for more cash, and many investors are refusing. That relationship is fractured. Now banks are conflicted too. They don't want those properties back. Foreclosures means they'll have to mark loans down, admit losses, and in some cases, risk their own survival. But at the same time, they can't ignore the math. When a property is worth less than the debt, then cash flow is gone. When insurance and taxes are strangling the deal, they're forced into a corner. And the conflict doesn't stop there. Property managers are caught in the middle. They're being asked to push rents higher just to keep the numbers afloat. But tenants are already stretched to the limit. Renters can't carry the burden of bad underwriting. That tension creates friction between management and tenants, and you can feel it on the ground. Late payments, rise in eviction, deferred maintenance. And let's not forget the syndicators themselves. The internal conflict is crushing. Do they admit failure? Do they tell their investors the truth that the deal is upside down? Or do they keep kicking the can, hoping the market magically turns around? This is where pursuit runs headfirst into reality. It's where hope collides with hard numbers. It's where people discover that willpower alone won't change math. Just like in 2008, this conflict is the storm before the crash. You can feel the pressure building. Everyone is looking for a way out, but most exits are blocked. The pursuit is over. The conflict is here, and next comes the breaking point. Now, for 2008, the climax came when the system itself collapsed. Lehman Brothers went under, banks stopped lending altogether, the stock market plunged, and the foreclosure wave wasn't just a ripple, it was a tsunami. Entire neighborhoods were swallowed. Families packed up and left their homes with nothing but cardboard boxes. The American dream felt like it had burned to the ground. That was then. Now, in 2025, the climax is building again. This time, it's not just family with non-conforming mortgages. It's the syndicators with massive multifamily portfolios. It's local and regional banks loaded with commercial real estate loans. It's operators who thought they had time, but tick-tock, the time has ran out. Bridge loans are maturing, interest rates are double what they were, insurance premiums have tripled, property taxes have spiked, and the rents everyone was counting on to rise forever have leveled off and in some cases declined. The math doesn't lie. Properties bought for record highs just 3 years ago are now worth millions less than the debts that financed them. Syndicators who raise millions from investors are watching deals unravel. Distributions have dried up, capital calls are going unanswered, and in boardrooms across the country, banks are having hard conversations about whether to foreclose or fail. Now here's my bold prediction. This climax will land hardest on regional and local banks. They are the ones holding most of the multifamily loans. They don't have the cushion of Wall Street. For some of them, one foreclosure, a single 200-unit deal going bad, can ripple through their entire balance sheet. A cluster of bad loans could take them down altogether. And when those banks are forced to take properties back, that's when the liquidation starts. That's when the prices collapse. That's when the tidal wave hits. And just like in 2008, it won't happen all at once. It will start with a few properties here and there. Then more. Then suddenly the dam will break and the market will be flooded with foreclosures. The climax is not just about numbers. It's about fear. It's about the moment when everyone realizes the game has changed. And just like in 2008, that moment is almost here. Now in 2008, the aftermath was devastating. Foreclosures swept across the country. Millions of families lost their home. Entire neighborhoods sat empty, lawns overgrown, houses boarded up. Construction stopped. Builders shut down. Property values collapsed as much as 50% in some markets. But that same aftermath also created one of the greatest opportunities in modern real estate. The few investors who had discipline, who had cash, who weren't over leveraged, they stepped in. They bought foreclosures for pennies on the dollar. They bought single-family homes in Phoenix, Las Vegas, and Florida that nobody else wanted. They bought apartment complexes at prices that looked impossible today. And those decisions created generational wealth. Now we stand at the doorstep of a new aftermath. The pressure is different this time, but the pattern is the same. The syndicators who overpaid will lose properties. Regional banks will be forced to foreclose. Insurance hikes and tax increases will keep crushing cash flow. And when those properties come back to the market, they won't trade at yesterday's prices. They'll trade at today's reality. Here's the truth. Values don't just drift lower in aftermath. They reset fast. And when they do, that's when disciplined investors, the ones who waited, the ones who prepared, step in. They buy the assets others are forced to sell. They create new business plans. They stabilize property. And just like after 2008, they come out of the storm stronger than ever. But we're not going to sugarcoat it. The aftermath will be painful for many. Families will face housing instability as landlords lose properties. Communities will see deferred maintenance, struggling tenants, and uncertainty. Some banks will consolidate. Some syndicators are going to disappear altogether. Yet inside of the chaos lies clarity. History doesn't repeat, but it rhymes. Non-conforming loans crushed 2008. Bridge loans, insurance hike, and over-leveraged syndicators are setting the stage for 2025. So here's the question I'm going to leave you with. Will you be swept away in the aftermath, or will you use it as a launching point? Because this is where the next generation of real estate wealth will be made. Not during the easy years, not at the top of the market, but right here in the aftermath of crisis. Thank you. That's it for today's episode of the One Deal Millionaire Podcast. If you got value from this, share it with a friend who's ready to stop playing small. And remember, wealth isn't built by watching, it's built by moving. So take what you learned, apply it, and keep the velocity of money working in your favor. Subscribe, leave a review, and stay in the loop at thebouncemethod.com. And until next time, keep bouncing forward.